to, or all of your money. Naked and other risky option trades have left many bankrupt investors in their trail throughout history. The software tools from ProfitMonk help analyze trading and hedging strategies and are only for information purposes. This is not investment advice, neither is it a recommendation to trade any security or options. So, having that out of the way, this is the agenda we are going to try and follow. Let's see how far we get. I'll introduce the index-based hedging algorithms that are now online on ProfitMonk.com, their benefits and risks. Try to finish it in first 10 minutes. How to use these algorithms in the next 10. That should leave us about 15 minutes for Q&A. I do not think we will be able to go to anything else, and that's why I kind of pushed this last item of the agenda to if time permits, but I'm reasonably sure that we will not go there. So, hedging, we hear the word in many different contexts. Hedging the stock investment portfolio, what, why, when, and how is going to be the key themes in our discussion over next 20-25 minutes. So what is it? Basically, the hedging is a series of trades or actions that we take. And why do we do it? The reason to do it is to protect wealth, to protect the portfolio during market downturns such as these. And you see all kinds of downturns in the market. This is, I would say, almost a pseudo-random kind of structure with a bias towards going up. That's the kind of function market is, because that's what we see. And this is a 35-year long graph. You see all kinds of crazy behavior, like what happened this year. Or what happened way back in 1987 during crazy Black Friday, or you see these sustained downturns as well for whatever reasons, but you see them for a reasonable amount of time. So objective of hedging strategies is to generate cash when times are good, because they are for most of the times, and then use that cash to be ready for market lows. And then once you identify the market lows, then maybe even generate more cash during the lows. So that's the objective. That's what hedging is about. Now, what are how is hedging performed? You will see this quadrant explains, at least at a high level of abstraction, two classes of hedging methods. The ones in top two quadrants, which is either shift to another asset class when, let's say, market crashes, or go to cash when market crashes. Both of these lead to tax burdens. Shift to another asset class could be metals, bonds, commodities. You could almost say that cash itself is another asset class. So these two are pretty similar. The other kind of hedge methods are, you kind of keep your portfolio wherever it is, but try to hedge it either through volatility instruments such as VIX, futures, VIX ETFs, or options on these, or you basically directly trade put and call options in representative indexes. And of course, the question in all of these scenarios, especially the bottom two, is, hey, when do we deploy these methods, and how to allocate assets during these? So in context of this, because this is the quadrant we will be focusing on for next 15 minutes, which is how to use put and call options in representative indexes to generate cash as well as to basically hedge. The questions are, hey, what to buy, which option to sell, what strikes, expiry, and how often to do it. So again, continuing with the how and when thread, there are 3 steps to hedging through index puts and calls in the ProfitMonk software that you can use. So that's what the software allows you to do. That's what the analytics allows you to do. So first step is, of course, to identify the index that best represents an investor's portfolio. So some of us like to play around with S&P 500. Some others like to play around and are more tech savvy and believe in the tech is king mandate more, would play in NASDAQ. So these are the 2 indexes, representative ETFs, SPY and QQQ. That represents either S&P 500 kind of investors or NASDAQ. The second step is to play spreads. Why play spreads? Because almost any hedging strategy that you use, which depends on, hey, the market is looking down because it has gone below a certain moving average or whatever, choose an indicator, take an indicator of your choice. It doesn't matter what indicator that is. And if you just use that indicator and based on that try to buy a put option, because that kind of limits your losses, it doesn't matter. Uh, your returns over time are going to be lesser than if you can just clench your teeth and buy and hold, because that's why hedging is kind of tricky, because if you hedge in too much and hedge in a non-optimal way, then effectively you lose money over long term. So when to do it, and that's where it's tricky. So basically, if you can identify uh, a consistent hedge method to maximize the time to remain hedged, then that's the best, which means you remain hedged most of the time. uh, you don't hedge only when the market is going down, but you remain hedged most of the time. And what does that need? You need a reasonable combination of put and call spreads, strikes, and expiry. So that's what is needed. And the purpose and objective again is to generate cash when market stays up, and risk mitigation in case of black swan events. And I don't think we should even call these events black swan events anymore, because they happen at least once or twice a year. So how do ProfitMonk algorithms work? And we will go into a demo on the web page very quickly. So let me just walk you through this in a high level of abstraction so that it's clear what you will see. You will see 4 types of hedges on the web page, on the tool, and you can adjust them through the tool settings, etc. You will see put credit spreads, and if any of you are not familiar with options, etc., I would encourage you to go Google. Don't spend money, but find out what options are and whatnot, because without that this won't work. And so you need to understand what options are. So you will see a put credit spread kind of hedge, to sell in the money put and buy out of the money or at the money put. You will see sometimes an at the money call type of hedge, at the money put hedge, or in the money call hedge. So these are the 4 types of hedges that you will see. The description is sort of self explanatory. Now when do we do this? Put credit spread is we do all the time, most of the time. Actually, probably I should have used that phrase, except when market is not optimal for such a trade. And when is market not optimal is pretty much how the algorithms look at the trend and identify and optimize for the trend. So it's nothing but sophisticated machine learning exercise to identify trends, and then turn on or turn off different kind of hedges, as well as the target um, expiry and target strike prices. So ATM call and ATM put you will use once in a while. You won't see that too often, but you will see them again based on when the risk reward ratio has historically worked. In the money call, it's an optional thing, but what I have personally seen for my own trades is that it works well in low volatility and trending markets, which is, let's say, 70-75% of the time. That's how the markets behave, and it has helped generate additional cash. But in any case, you can control the settings on the software to turn on or turn off at least ITM call hedge, etc. So those are the 4 kind of hedges you are going to see, which brings us to the quick demo of so I hope all of you guys still remember your logins and passwords, but if you don't, just it's your mobile phone number and some email ID. You can grab it on the website somehow. So you will see 2 kinds of 2 links here on the first page: the hedge credit spread for NASDAQ 100 and the hedge credit spread that mirrors S&P 500. So those are the 2 pages you will see. I have just opened the NASDAQ 100 and S&P 500 page so that we can walk through it and understand how this works. When you click here or here, right now we are opening NASDAQ 100 page, so you will see something like that. And if you see something different when you are doing it on your own, using your own account, I'll tell you what kind of setting is needs to be done in the account settings that can help you get different kind of to match these numbers. So this is the key statistics for most recent 1799 trades that have been made since January 2013. So every trade is basically some sort of spread. Okay, so we talked about spread. So every trade is a combination of put credit spread, or in combination with ITM call, or it may be a ATM call and ATM put. So every trade is basically a spread. Um, Across all these trades, you see about $180 average profit. So a very small number of trades made a large amount of money, but I don't think that's that interesting. Win ratio is about 47%. Different graphs. So profit versus losses in dollar for all these trades. So you basically had about 900K of profit and 568K of losses. I think I should have highlighted that this is basically, this analysis is assuming that you are trading one contract per spread, per trade. You can trade any number of contracts, it's your choice, but this is basically assuming one contract. And I think what's interesting is to understand what's the risk, what's the cash that you are actually need to commit to this, so that you remain hedged in a better way. So we'll talk a little bit about that, but let's leave that for later. So it's not just important to have a profitable strategy, the profits have to be reasonably linear as well, because if there is a strategy that only works in case of black swan or extreme events, then and it's a good strategy, but then it demands a lot of cash and it demands a totally different trading mindset. I think trading mindset is something that everyone runs their trades differently. Some people are pretty consistent and persistent, and but most of us are not good at taking pain. So thereby linearity is important. So how linear have the profits been is this curve. So if you see, I have recorded this since 2013. So 2013, and of course I have not made all these trades. I started trading this somewhere here in this time frame, and I have gone through some pain, but the back testing is goes a little while back. So end of 2013, this is at about 32,000. It's a small font, that's why I'm kind of hovering the circle here, hovering my mouse here. End of 2014, I think it was about 50K or somewhere in that range. 2015 was actually it went down to less than 35 or maybe 40K. So I think somewhere here is 2015. So 2015 went down, 2016 essentially flat, up and down. 2017 was a splendid year. 2018 was a good year, but of course there was this blip from October to December. But then the hedges converted and changed. Basically, it worked in a different way for using those spreads. And then, even though the market turned around end of December, I don't know if you guys remember, but the hedge started turning around at start of December itself. So that's what happens. And again, it pretty much behaved really reasonably well during these February and March insane months. So basically, the key was, this was the time frame, right? This was 21st February, I think, or okay, this is sometime in February. So this is 21st February. This is when the market really went crazy, and then it remained bad till 6th April. And then you actually see that the hedges worked in your favor in this time frame, and you actually were able to hold up pretty well. So that's how the linearity has worked. There are some other curves here, which I'll skip this one, free cash flow over time, because this is basically another version of this curve, the profit curve, except that you are talking about this blue line, which is the net cash that you have generated, which is the difference between cash invested in trades and the cash received from trades. So I'll just take one per trade, for example, and then we can go to Q&A and steps. So this is how you read the table. So this table, so let's look at the top three rows, which are all dated August 6. So August 6 was yesterday. So it's important to understand that the algorithms and software analytics runs after the market closes for the day. So this basically ran yesterday, and you will so for example, I executed these three trades, the top three trades, which are all on August 6th today. So you always execute the trades on the next day and next trading day. So for example, the trades that will pop up tonight, you will be executing them on Monday, and that's how the buy execution is recorded and updated as well. So right now you do not see any difference because the software hasn't yet run. You will see the difference once this runs for tonight, and it will basically record the price at which the trade gets executed, not just the price at which the trade gets flagged. So what are the trades? You see buy put, which is OTM, $262. And right now we know that the market is around 275. So it's basically an OTM put. You see a sell put at 286. So that's the put credit spread that has popped up. You also see a ITM call at about 266. So you see the combination of these three things. If you make all these three trades, you basically that's what you do pretty much most of the time. And you will see that on August 5 as well. If I go a little bit down, it'll make these same three trades. Of course, it'll pick up the strikes slightly differently each time, depending upon how the numbers and volatility, etc., are in the market. It will pick expiry also based on how the volatility is looking for these trades. But typically, what I've seen is that this ranges between 2 to 4 weeks of expiry. For QQQ, the expiry day of the week is always Friday. So these dates will always be Fridays. So that's what happens generally. Now, what's interesting is how the strategy changes if, let's say, something in different ways. So I know sometimes you will be buying. So for example, if you go down to April 6, which is when the market really came back up and became kind of it came out of the bear hug totally, although it was going up for most of March as well. But you will see this different time frames where you will not be doing these spreads. You will just be doing put contracts, right? And you will probably doing skewed put spreads where you will see this OTM put being bought, as well as you will see an ATM put being bought. So it changes its mind. It's like a chameleon. You will also see sometimes ATM calls being bought. So if you search, and you can do this analysis yourself, search for ATM call, and you will see that ATM call starts to appear pretty frequently in March, April, May timeframe. But apart from that, it doesn't. Actually, you can see it here. There are only 93 times you have seen some sort of ATM calls. So the strategy changes the kind of spreads that you will trade depending upon the trend that it sees in the market. Okay, so I think let me go back to the presentation. Before we go to these steps, I think we can stop for some Q&A. Guys, if you're trying to ask a question, you're on mute, you might have to click your unmute button. Oops. Okay, so let's go forward. So basically, it's nothing but a 6-7 step process, and actually you just have to execute the top 5 probably. First is decide whether your portfolio looks like Nasdaq or S&P 500. Look for trades on top of the table on the web page. Enter a put credit spread, and on expiry day you have to close the put credit spread. So basically this is something that you'll have to do. Enter the ATM long call and ATM long put when analytics flag it, and if in case you have entered them, you will see on the web page that for these ATM long calls and puts, you will have limit orders with target prices. And again, the last 2 steps are optional. I do it. It's up to you if you want to do it, and you should analyze the results with and without it. If you have a bullish bias at some certain point of time, then enter the long call trade. I pretty much entered a long call trade most of the time as well. And in case you bought a long call, enter a limit order at target sell price as well. So these are the 7 steps you got to do. How often do you have to do it? I think that's interesting, but I kind of can walk you through that as well. What you were looking at in the web page settings here is basically every day. Okay, so every day for last 6 years, if you make one trade, that's how it'll look. But you can change this if you go to your account settings here, and if you search for this particular method, if you search for hedge here, um, and what you will see is that there is a setting here. If you change it to no, then it kind of reduces the frequency a lot, and you can try changing it, and most probably it is a no for your settings mostly. So I think that's what you would see, and then which it will change the number of trades, the frequency at which they appear, the number of how often you have to make it. By the way, I just came to a different page which is for SPY, the same hedge spread tool for SPY. So effectively what it means is that if you were making these trades on a consistent basis over last reasonable length of time, then it has been pretty beneficial. Okay. Any other questions, folks?
Hi, Hash. Just a question. Like I see that you are giving this one for triple Q and SPY. Any chance you are extending to individual stocks like Microsoft or something like that?
So yes, I do it. I think, but that part of the strategy is used by some hedge funds, so I'm not allowed to actually bring them out to retail investors. Um, so that's the challenge. Uh, SPY and QQQ I'm allowed to bring out because for different reasons. I don't think any of the hedge funds who are actually using this channel are have any heartburn with that. But that's what it is right now. And generally, I at least personally always keep a reasonable part of my portfolio in these indexes. They are the best stock holder of value in the stock market. So, Sarath, I keep it that way.
Okay. So the other one is, I think I just need to go through steps. Like you said that you need to close at the expiry date, like to reduce the cost of trade. Like, can you?
Yeah, this is the reason. So I'll explain you why I have to. So for example, I did close some trades which were expiry date August 7 today. Today is August 7, right? So let's search for some trades that would have happened. So yeah, these are the trades that I closed today. And why do I have to close it? I think in this case it worked pretty well because this is the contract that I sold back on July 23rd, and I sold it at 272 since the market ended up above 272. uh, I think it's close to 272, so it's not a problem. You probably can let it go, but there will be situations when it will not end up at this particular put contract, especially the ITM in the money contract, may still end up in the money because the market hasn't gone up so much. Mostly it will be that situation. So you want to make sure that it doesn't get assigned to you, and therefore it's important to close it.
Yeah. I encountered a couple of times assigning. Yes.
Yeah. Okay, so basically you are making one spread pretty much every day, or if you change your settings in the hedge methods, you are making much lesser number of trades, which is this setting right here.
Okay.
Okay, I didn't realize that we will end up with such a quite bunch of people, but except Sarat for you. Um but I did create some sort of Q&A still, which may be helpful for you guys. So, for example, if you don't understand how options work, I guess that's the first step. Please try and understand that. How often do you have to trade to remain hedged? I would say at least once a week. You can adjust to one contract, or you can adjust to more contract, or you can do 2 or 3 times a week. I pretty much do 2 or 3 times because that's all the time I have. But that works pretty well. So how many types of trade are generated? We talked about this. You will see 4 kinds of trades: credit put spread, long ATM calls, buy ATM puts, and buy ITM calls. Should I enter all types of trades? I think I do. Historically, hedging results have been better if at least these 3 types of trades have been done: credit put spreads, buying long ATM calls, and buying ATM put. But it's your choice. You should definitely analyze it um, and make the decision that works for you. What's the cash risk in this strategy? I think this is the most important question. How do you control it? Do you look at risk on a per trade basis or in any different way? So, for any given trade strategy, the risk has to be analyzed based on maximum drawdown over time. So, you should look at the profit over time curve, the curve that we were talking about, which is um, on top of the page right here. This is the profit over time curve, and you should look at that. And basically, what's your maximum drawdown? So, you see a drawdown here, 142 coming down to about 95,000. You see a drawdown here, 61 kind of coming down 34. And if you are one of those unlucky ones which kind of chooses to enter the market here, then that's the maximum drawdown. Generally, you enter anywhere and you can look at the maximum drawdown. So that's your money at risk. Okay, and then you can change your software settings and analyze it. The difference between the highest and the lowest is the historical drawdown. Basically, that's your risk. Okay, so if you look at it from a per trade basis, that's mathematically incorrect to look at the risk that way if you are executing a lot of trades. Now, for playing one contract since 2013, what I have seen is for different kind of settings, the maximum drawdown has ranged between 20K to 55K. So basically, this is equivalent to 100 and 200 to 200 shares of SPY. So what I do is that if my portfolio is, let's say, 1,000 SPY shares, then I will keep about 100 to 200 shares worth of money in cash and use that to play these hedges. And look how thanks Zoom. Okay, and look how this has worked because with that kind of drawdown over a period of time, we have averaged a reasonable amount of money every year. That has helped us during these downturns. So you have to look at this whole thing as a combination of how your portfolio is doing and how your hedges are doing. Although some people can actually just play these hedges and keep the portfolio totally separate, and even that is, I would say, an acceptable model to be part of your portfolio. So that's the cash risk in the strategy. You can control it in many different ways by changing the number of contracts, by changing how frequently you're trading, but you have to be disciplined about this trading to make persistent profits. There are some defined steps. Generally, you will be entering the put credit spreads. You will always be executing it on the next trading day. If you want to be close to how the tool's data is, then enter the trade close of market towards close of market next day. That's when generally it records the trade execution price. Typical day of expiry is Friday, but for SPY contracts, it may be any other day. So be careful if you're playing SPY. Yeah, otherwise you may get assigned, and then it's not a disaster. It's just a minor issue. When your software settings identify a potential hedge trade for ATM call or ATM put, you execute that and enter a limit order to sell it at the target price. So this is basically the steps. There is another interesting Q&A. I've come across this. Some people have asked me this, that some periods in the profit curve have essentially been flat or negative. So example, if you look from 2015 mid to most of 2016, how do we tackle these situations? So I'm talking about this time frame, right? So it kind of peaked in July 2015. If you can follow my cursor, you'll see it about 60,000, and then it kind of went down quickly to 35 and then stayed essentially flat till it started going up towards end of 2017. So this is a long period of no cash generation, but you are still playing the strategy, and you're playing the strategy because you don't know when this will turn out. So the objective of this hedge strategy is to minimize losses to index-based portfolio during downturns. Now, this is achieved by generating additional cash in favorable conditions. Now, it's not possible. I know I play a lot of quant, but I'm pretty clear that it's not possible to time the market behavior to create favorable returns all the time, which means that you have to have strategies which change your approach and adjust your approach based on how the trend is going, and overall in a statistical positive sense it should have a positive expectation, positive gain. So we will always have these periods which are flat or negative, but we will also have periods which are not flat or negative, which work very well. I mean, even this period, for example, this was negative, but then what I've typically seen is that high volatility always ends up with more gains eventually once we come out of it. And if this high volatility persists, then you will see this kind of behavior. So for example, here, if you see 4 December 2018, or actually this is maybe a better example. So right now, right here, the market started going crazy, like 22nd, 23rd February, and look at how the strategy behaved. So it kind of actually went up. It took advantage. It was able to take advantage of that volatility in this time frame in a pretty reasonable way. Okay, so that's all I had, folks. If you have some questions, queries, drop me a note on WhatsApp, or send me an email on the Monk address, and enjoy trading. If you have any question now, shoot, because I think Zoom has given us a few more minutes.
Thank you, Ash, taking your time and presenting on this Friday evening. I think what you're doing is wonderful. Hope we take advantage of the resources which you are providing.
Thanks, guys. Have fun.
Yeah, thank you.
Bye.